All right, guys, welcome to Chapter 8, discussing the efficient market hypothesis. It's actually one of my favorite topics, there's a lot of debate around it. How efficient is the market? I also think that depends on what part of the market you're actually looking at. I think some parts of the market are fairly efficient. There's not much value in doing too much more research in a certain part of the market. It doesn't add that much alpha, but there are other parts of the market that might be more uncovered and have the opportunity to find value to add to your portfolio. However, when you find an undervalued stock, for you to be right, the market needs to catch up with your thinking. So you need to effectively be right before everyone else is. And a lot of times, that's very difficult. If you think about the people who started buying stock in 1-800-Flowers leading up to, and during the first week or two of the pandemic, they made an absolute killing. Think about the people who invested in home gym maker equipment, not Peloton, but Nautilus. And as gyms closed, people bought more gym equipment. So you would have to be pretty early in your thinking to take that kind of chance. And as the pandemic began, most investors weren't thinking 1-800-Flowers stock as well as gym equipment. Great. So I'm going to switch the slides here, and always, guys, feel free to ask me any questions. You can leave questions in the comments on YouTube as well. So the efficient market hypothesis. Random walks in the efficient market. So the random walk is the notion that stock price changes are random. There is a huge element of randomness whenever you're doing investing. For example, you could be right about a stock in terms of beating expectations, but the stock could still go down on the same day it reports that good news. One risk, if anyone here uses options to invest in the stock market, which is a highly risky and not recommended way to do so. If you bet on any of the earnings coming out over the next 2 weeks, there's a risk factor that's outside the scope of the company, and that's the market risk of the election. So if there's some wonkiness with the election, but your stock beats earnings, that random event could really change the course of the price in that stock. When you think about other large events in history that added an element of randomness, even small company events, your car company could have an issue with its brakes that was not predicted in any of your financial models, right? Sometimes it's just a string of bad luck. You can look at companies and who they hire to run their business. Is there a risk of any personality in there? So the efficient market hypothesis states that prices of securities fully reflect all available information. One item that disproves that is that once a company is targeted for acquisition, meaning a bigger company usually is buying a smaller company, the price immediately goes up, right? If the market was perfectly informed, it wouldn't necessarily rise that much on a takeover, because the prospects of a takeover would be baked into the price of that stock, and it clearly wasn't. Usually it's a function of percentages, right? Meaning, a stock might have a takeover value, meaning like if someone would buy it, but if no one's interested, what is it selling for, right? What do you think its expected market value is? And sometimes that can be also a function of probability. If 80% of people or 90% of people expect a stock to exceed its earnings, then likely if it does, it's not going to move up a whole lot, because usually it will move up in advance of those said good earnings. Stock price reaction to CNBC reports. So when CNBC has a positive report, the stock usually ends up positive, but stocks are hurt much more by a negative report than benefit from a positive report significantly. So one thing I have a story there from is I invested in Care.com at one point. Since I invested in that stock, it's been taken private. Effectively, the stock dropped about 35% after the Wall Street Journal wrote a story that said Care.com, which is a babysitting service, didn't vet their babysitters well enough. because the background check they do was a point in time, meaning they do it when they start the service. But any crime a babysitter potentially commits after they start and after they complete their background check isn't captured. So, that seemed pretty logical, but I think the market overreacted, and it sold off very steeply. And then once it sold off steeply, a private company went in and bought it. I think the market overreacted to that negative news. I think that the same reason they overreacted to that negative news was the other reason that another company was able to come in and buy it relatively cheap. Competition as a source of efficiency. Investor competition should imply stock prices reflect available information. Investors exploit available profit opportunities. Competitive advantage can verge on insider trading. So that last comment is really important. Talk about insider trading. Is it a competitive edge, or is it inside information? Well, I think it really depends on the context of the information. I've had scenarios where people have said, "Oh, look at this biotech stock. It looks really interesting." Like, biotech stocks are notorious for, like, I hear they're going to have a drug developed. My buddy's friend's mother told me. Usually when I hear something like that, I never go and buy on that information. But if one or two people told me about a biotech stock that they heard was interesting, I would then begin to do research on my own. And that's called the mosaic theory, right? When you have maybe potentially inside information and then you research and disclose after the fact. If there was any kind of potential insider information, you effectively marry that with publicly available and public research to collaborate your theory of why you should buy it, right? But that process, can potentially lead some to think, was that inside information? Weak form, efficient market, stock prices reflect all information contained in the history of trading. Weak form only says, that technical analysis does not work. As most of you might know, I'm not a huge fan of technical analysis or trading patterns. I think there's a lot of randomness involved in that. And I think you're wrong just as much as you're right on technical analysis. It can be helpful in short-term momentum trading, though. Semi-strong form says stock prices already reflect all public information. So semi-strong effectively says, the only thing that's not included is insider info. And then strong form EMH says that stock prices reflect all relevant information, including inside information. And that might be true with some really big names that are just like too public, right? Too big, too large, because they can't make any moves without everyone knowing anyway. So technical analysis is research on recurrent predictable price patterns and on proxies for buy and sell pressure in the market. Now, I often think technical analysis is often a bunch of witchcraft, but there is some logic behind it. It's often more based on psychology than the actual pattern itself. For example, anytime the market's dropped, I think more than 35%, within 6 months, it's been a higher price. So, that's a form of technical analysis. You're assuming there's going to be a repetition, like the current cycle will rhyme with the past. But, there's a lot of factors that will make that true or not, right? But it could be a fairly accurate predictor. And there's a whole bunch of other technical patterns in prices that can indicate waning optimism, meaning like there's lower lows and lower highs, meaning like maybe the pressure is coming off the stock in terms of buying pressure. There could be resistance levels. You'll see some stocks, as soon as it hits a certain price, it's hard for the stock to seems like it can't get over that low price hurdle. Why does that happen in real life, though? What is the cause of that? That's because individual investors I have a $30 price target. So as soon as it hits 30, people start selling their positions, right? No one ever says I have a $32.67 price target, right? These points of resistance often happen at full dollar values. And there's also support level, and this is often done sometimes even with drawing a straight line through the bottom of the chart. Where is it likely to find support? Meaning it's likely to find support in other historical low prices. Where has the stock bottomed before? But the problem with looking at that is that you assume it's normal course of information. There could be some really bad information that causes that floor to kind of be dropped. Fundamental analysis, that's research on determinants of stock value, earnings, dividend prospects. For example, Exxon, this is being recorded in what month are we in? October 2020. And the market will be looking at Exxon on Friday to see if they can maintain their 10% dividend. I have doubts that they will be able to support that. They'll probably cut it at some point. Future interest rate expectations and firm risk. Assumes stock price equal to discounted value of expected future cash flows. So one problem with fundamental analysis is that if the business doesn't generate cash yet, it's hard to perform fundamental analysis. Active versus passive portfolio management. Passive investment management, and we talked a little bit about this last chapter, involves building a portfolio of well-diversified assets. Effectively, it's a buy and hold strategy. You buy some index like the S&P 500, which is the 500 U.S. stocks, largest. Or you could buy the Russell 3000, which would probably be my preference because it captures the small caps, right? It's the 3,000 largest stocks. The Russell 3000 actually can be broken up into two separate indexes, the Russell 1 and the Russell 2. The Russell 1 is the 1,000 largest, and the Russell 2 is the 2,000 smallest. So, but the S&P is the most common. And the Dow Jones, while we're talking about passive strategies, is also a passive index, but it's not really based on as many rules as the S&P 500 is, because all those other indexes are measured by market cap. The Dow Jones is actually hand selected, meaning a committee selects the names that are to be representative in the Dow Jones. Index fund or a mutual fund or an ETF, which holds shares in proportion to the market index. Most of these funds, if you have the S&P 500 fund, typically, it should own all 500 stocks because they're all big and liquid. But if you own like a small cap fund, like the Russell 2000, what they'll often do in that is that you don't have to buy all 2,000 stocks to get the performance, because some of the small stocks at the bottom of the index are so tiny. You could probably just buy like 1,500 of those stocks to represent most of the portfolio performance. And sometimes these funds will do sampling instead of replication when it comes to building the passive strategy. Role of portfolio management in an efficient market. So the portfolio manager helps make the market more efficient, in aggregate. If I like a stock and I buy it and everyone else starts to like the stock and they buy it, what does that mean for the market, right? It's going to push the price higher because we believe that the value is going to be there in the future. And then as quarterly reports come out, we decide if they're meeting expectations or not. If they consistently miss expectations, people will sour on the stock and move away from it. Passive management is really consistent with semi-strong efficiency, the middle ground, and efficient market pricing leads to inefficient resource allocation. So, it's important that we're efficient with our resources. And again, active management assumes market inefficiency. If the market was perfectly efficient, I would never be able to outperform the market. One thing about efficiency, though, it's relative. It's not binary. It's not like, is it efficient or not? It's really a question of, how efficient is that market versus is it a pure yes or no question? So there's also a selection bias issue. Investors will find successful investment schemes are less inclined to share their findings, right? So once you find a strategy that works really well, you don't want to go and publish it, because what happens? Well, then everyone knows about it and your edge actually disappears. The Fama French model that we talked about last chapter, really based on a theory that small and value stocks tend to outperform over time. Since the research was published, small and value stocks have had a heck of a hard time performing. That could be a function that they published their research. So now that everyone knows that small and value stocks tend to outperform, maybe that's no longer true. Observable outcomes pre-selected in favor of failed attempts. So you also want to, see you only get to see the methods that have worked. You don't get to see if someone backed into the data and made 100 wrong choices until they accidentally got to the right one. Lucky event issue. Lucky investments receive disproportionate attention. So if you're a portfolio manager, well, yeah, I'll give you an example this year. There's a couple stocks that I've owned this year that have really aided my performance. And those stocks probably account for the majority of my alpha this year, probably in like 2 or 3 names. The rest of the names probably performed on an average level, but the handful that killed it really drove all my performance. Now, did I select those names based on luck or skill? Well, that's going to be really hard for you to determine based on one event. You're going to have to look at my portfolio over time. If I held a stock that went up, 1,000%, that could drive the returns in my portfolio for years to come. Did I get lucky or was I good? Well, I'd want to see what drove my performance, and outside investors should want to see what drove my performance. Was it driven by one name or a handful of names? I would rather see someone with skill, get a handful of names right than one name out of 30 really right. I'd rather see 5 names out of 30 do pretty well than one crush it and the rest not. It just reduces the likelihood that it's luck. And luck versus skill is interesting too, because that's not binary. That's also relative. Because you're always just, when you're looking at someone who's good or lucky, you're really just measuring, the likelihood of luck or the likelihood of skill. If someone's good for a long time, you increase the likelihood that it's skill and not luck, right? Short term, it's probably more luck than skill. I was talking to an investor who put most of his retirement assets into Tesla, and he probably did really well over the last year or so. But is he better than me, or did he get lucky? That'd be a good debate. The momentum effect is tendency of poorly or well-performing stocks to continue abnormal performance in the following period. This is actually an interesting one. This has to do a lot with psychology. When you have a stock that does well, you're likely to tell your friends about it, and they buy it and they tell other people, oh my God, you got to buy Tesla or you got to buy Bitcoin. I remind people these hot stocks, the hot stock in 2014 was 3D printers. The hot stock in 2016 was marijuana stocks. 2018, it was Bitcoin. 2020, it might be electric vehicles, right? Returns over a long horizon. Also, the other side with momentum works on the downside too. The other thing that actually makes the momentum effect more real on the downside, especially as we're in the last kind of 3 months of the year, stocks that have had a loser of a year, meaning everyone, if you look at the stock chart and it's just kind of people who own it now, everyone who bought it this year has lost money. Those are usually stocks that momentum especially will continue downward on, because a lot of taxable investors who own that stock will end up selling loser stocks at the end of the year to reduce their gains and harvest the loss to lower their tax bill. Even if they like it, they'll sell it just in order to get the tax loss and then potentially rebuy it at least 30 days in the future. Right? They have to wait 30 days to take the loss. The reversal effect is the tendency of poorly or well-performing stocks to experience reversals in the following periods. So that characteristic I mentioned with tax loss harvesting, if you find a loser of a stock that just continues to get pummeled towards the end of the year, once the new year hits, those stocks usually are reinvigorated. Predictors of broad market performance, again, Fama French, return on aggregate stock market tends to be higher when dividend yield is low, right? And there's a variety of reasons why that is, right? Return on aggregate stock market tends to be higher when dividend yield is low. 1988, Campbell and Schiller earnings yield can predict market returns. So again, if the dividends are low, that usually is an indicator that the market can go higher. If earnings yield is high, that usually means the market can go lower. And then the bond market data and the spread between yields can predict market returns. That's interesting. How can the bond market help predict stock market performance. It actually, the bond market, the difference in interest between a safe bond and a risky bond is considered a spread. When spreads are high, that is usually a good time to invest, because high spreads means there's investors are expecting a higher yield for the really risky assets, which means typically a higher risk premium, linking it to the CAPM model. When yield spreads are low, that means you're not compensated hardly at all for owning a risky asset. Risk premium small, therefore potential for market performance is low. Semi-strong tests of market anomalies. So patterns of return contradict EMH. The PE effect. Portfolios of low PE stocks exhibit higher average risk-adjusted returns than high PE stocks. That also, I think, depends. That's based on all these Fama-French models. However, is that always going to be true? I think that depends. Other small firm effects. Small stocks of small firms can earn abnormal returns primarily in January. That goes back to what I said before about a lot of people sell their smaller underperforming names at the end of the year and rebuy them in the new tax year. So the January effect seems to be valid. Neglected firm effect. If you find a little known stock and no one's covering it, there's a stock, and I'm not recommending you to buy it. This is just a story. There's a stock I follow called GAN. Ticker symbol is GAN. And, they do casino software. And I think the model for casinos changing in an online environment is extremely likely. And I think this firm has a high ability to grow. But it doesn't get a lot of coverage. I have research tools that allow me to see, the coverage of certain stocks. And maybe at the end of the slides, I'll just show you some of the tools I use here as well. I think you guys will find that interesting. Maybe I'll even do a separate video on that. Book to market effect. Shares of high book to market firms can generate abnormal returns as well. Post earnings announcement price drift. So, a lot of earnings are happening this week. And again, we're in the middle of October when this is being recorded. So, you'll have companies, dramatically, and I mean dramatically, maybe more than a 5% movement on one day or more in reaction to earnings. Right. So the value of the firm changes significantly. For example, Snapchat is, they reported earnings, I think, early last week, and they were almost worth double than what they were a month ago. Abnormal return on announcement day. Momentum continues past market price. Why would that momentum continue? I believe in factors as a predictor of past performance, but what most investors don't know is when a stock will become a momentum stock and when one won't. For example, some of these casino stocks with online gambling exposure were not momentum stocks until the day they became one, right? Bubbles and market efficiency. So speculative bubbles can raise prices above intrinsic value. I should also mention that maybe these online casino stocks are the 3D printing marijuana stocks of 2020. That also could be the what's going on here as well, right? There could be speculative bubbles in online gambling stocks. Maybe it won't be as big of a business. Maybe legislative hurdles for the additional 12 states that should come online after November. Maybe those are optimistic. This is the average return from 1926 to 2013 based on size portfolios. So what it says here is that smaller firms tend to outperform. Part of that is this small size effect. If you're small, it doesn't take a lot for you to, on a percentage basis grow. But if you're already huge, like a Nike or a Google or a Facebook, it takes a lot to get you even bigger, right? Because the growth needed is so large. Average annual return as a function of price to book. So we see high price to book values tend to do better. Sometimes this high price to book, book to market, is effectively a measure of value. and then cumulative abnormal returns after earnings announcements, right? So the best and the worst, how much they can move. And, you can see something with a, you know, earnings surprise, a positive one, can go up on average as much as 8% in a single day. That's really great. Anyone who trades options knows that those kind of trades can make you a lot of money. So, again, not recommending it, but, looking at that earnings announcement theory, if you trade very short options around earnings periods, it's a lot like buying lottery tickets, but you're doing it on the assumption that you think you know more information about the earnings that are coming out. Also, in regards to insider trading, that's how a lot of the insider trading gets caught. They make really abnormal moves in stocks that are like not frequently traded. So you might see someone with inside information make like, really risky bet. In fact, if anyone's ever watched the movie Casino Royale with James Bond, the whole plot of that movie is actually based on stock options. The terrorists were going to blow up a plane, but not only were they going to blow up a plane, they were going to short the stock of the company that owned the planes. So not only would they cause destruction, they would profit off of it. So when James Bond stopped the plane from blowing up, the stock didn't go down, and the bad guy investors lost all their money. Hence the conflict, right? So not a lot of people realize that. So if you watch that, this Casino Royale again, you'll be familiar with that. Fama French again says market phenomena can be explained as a manifestation of risk premiums. And then the next one says market phenomena are evidence of inefficient markets. So, the fact that, the January effect still happens, is a measure of an inefficient market. But part of the reason for that inefficiency is the tax structure, right? Like you have this holding period return. Most investors like me harvest losses, around this time of year towards the end. So, again, the losers keep losing and the winners keep winning, right? One last comment around tax loss harvesting. If I'm tax loss harvesting, this is just practical information. If I'm tax loss harvesting, let's say a bank that's lost money this year, in order to maintain that exposure, I might buy a bank ETF in place of the bank I sold. And then after 30 days, I'll sell the bank ETF and then rebuy that bank. Hopefully the price hadn't moved that much because the ETF, should loosely, track the banking index, or the other way around. The performance of the stock should loosely follow at least the banking index, so you don't lose the market exposure. So what you'll do for investors is sell the position at a loss, rebuy the ETF equivalent, wait 30 days, and then rebuy that asset. There's a couple other strategies with tax loss harvesting. You could double up on the position, then wait 30 days, and then sell the older position at a loss. But the risk with that strategy, there's always risks, is that if the stock, you have double the exposure for a 30-day period, right? There's risks in that. Interpreting anomalies. Anomalies are data mining. Some anomalies have not shown staying power after being reported. So the small firm effect. So we talked about that, and book to market effect. We just talked about how that hasn't shown in recent years. Well, I think this has to do. My theory on this is that all these computers and software algorithms that are based on these rules, like small outperforms and value outperforms, those same rules, the fact that we know them and they're baked into these computer models, make them not work. Stop return to style portfolio as a predictor of GDP growth. Stock market analysis. Analysts are overly positive about firm prospects. So, right now, I think out of the earnings that have been reported, more than 70% have beat expectations, right? So, but, I think the analysts expect 86% to beat on expectations. So, when you think about that from a company perspective, the individual companies are actually more likely to be conservative about their assessments because they don't want to not promise and then not deliver. But the analysts then assume that they're under promising, right? And then they make optimistic assumptions. And again, when you add up all these individual psychological aspects, that's how you get, some of these anomalies. Level of consensus is inconsistent predictor of future performance. So even if it doesn't matter, the consensus doesn't matter as much as you would think. Firms with most favorable recommendations outperform firms with least favorable recommendations. So if you see a lot of people recommending a stock, what will likely happen is money pours in, right? This goes back to like the winners win. For at least, momentum can work in a short period because people believe it, and then more money pours in regardless of results. Mutual fund managers, today's conventional model is a Farmer-French model plus a momentum factor. So a lot of managers use that style. Maybe it's why it doesn't work. Could also be the reason that active management has, for a number of years, underperformed the market. Funds show positive gross alphas, negative net alphas after controlling for fees and risk. So, on average, right, the average portfolio manager is just average. But once you account for like potentially high fees, on average, you should just invest passive and cheap. But, there are investment managers out there who do show skill and do have reasonable fees. So it's like almost like finding a good baseball scout. Minor persistence in relative performance across managers, largely due to expense and transaction costs. So if you see differences, sometimes when I'm doing competitive analysis and I'm seeing what competitors are invested in, and a lot of times I find that competitors are more expensive than me, I can look at their cost. I'm like, well, the difference is actually we're pretty much the same, except they charge twice as much. I saw someone earlier this week who had total fees of 2.3%. If the market's only expected, if you're full in the stock market, the market's only expected to return 8, and you have someone taking fees of 2.3%, that's a high fee hurdle to overcome. Like, can they add 2.3% of alpha every year to make up for those fees that they're taking, or are they going to under-deliver on performance? My experience is that the high fee funds generally under-deliver. Burke and Green said skilled managers with abnormal performance will attract new funds until additional cost complexity drives alpha to zero. If you're really good, eventually you get too big, and even you adding to a stock or a fund will like move the market. This is like a problem like Warren Buffett has. Like anytime he buys something, it'll start going up because he's buying it, and everyone starts herding around him. Next, on average, bond mutual funds outperform passive bond indexes in gross returns, underperformance once fees subtracted. The bond market is actually super inefficient, and it's one of the easiest markets relative where you can beat the index. In the stock world, you have to find the good ones. In the bond world, all you have to do is avoid the bad ones. You find an index of bonds, and in order to beat it, you just find the crappiest bonds and you try to exclude them. I'm obviously simplifying it, but on a base level, that's why it's a little bit more difficult. Because with bond, if you just screen out the bad versus finding the good, I think screening out the bad is a little bit easier. Next, stock pricing ability of minority of managers sufficient to cover costs. Performance persists over time. The next, records of most managers show no easy strategies for success. Meaning, if you want to be good and have a strategy, your strategy also has to evolve and change over time, because as we've seen with the small value factor, some of these sources of alpha can deteriorate over time. Mutual fund alpha is computed using 4-factor model. So, they're using a bunch of different factors here, 4. And then, on average, a lot of managers don't add any value, right? Only a small portion. The majority, and we see like the big fat tail here, right? The majority of managers add a small amount of value right there in the middle. A even smaller, teeny handful beat the market in a big way. When I talked about overcoming a fee hurdle of 2.3%, only looks like 2% of investors end up beating the market by about 1.5%. So you'd have to be an all-star to beat the market by more than 2.3% to overcome those fees. Persistence of mutual fund performance. This is actually a great luck versus skill chart. I should probably save this one. Luck versus skill. What this says, from best to worst, anybody can be awesome or terrible in a given year, but everything usually reverts to the mean. And over a 5-year period, the spread between best and worst is much tighter because laws of average have kicked in. So in a 1 year, you can have really wild performance, but over a 5-year period, it can vary. The variance becomes and standard deviation become much tighter. Risk adjusted performance in ranking quarter following the quarter. So if you've done really well, what happens is if you've done really well, usually within a year and a half, 6 quarters, your ranking has reversed, right? That might be a function of what you hold. If you've held these winners, that are momentum stocks, and you hold them for a year and a half, maybe the momentum has faded on those stocks, and you still hold them as they start losing money, right? So that leads to other psychological factors in investing. Like if you have a stock that's done really well for you, you might start to personally love that investment, and you might be refrain from selling it. I was actually talking to a client early this week, and he had a big position in Exxon stock, and I was like, there's no reason to own that much energy. He had 15% in energy, and the benchmark only has 5%. So it's almost not even worth owning energy in my view. But it turned out it was the first stock he ever bought, right? So I was like, oh well, that makes sense, right? Professional managers use margin of superiority likely too slight for statistical significance. So if you added up the average of superior manager performance, what this model is saying is that it's too hard to find a good manager to beat the market, right? Because if you're a good manager, they might have hey, I only have a $3 million minimum, right? That is the end of this chapter 8. Hope you guys found it interesting. I do really find the topic of market efficiency pretty fascinating. How that works when the market's efficient. Luck versus skill in investing is also another characteristic and anomaly in the market I find interesting. You're good for 1 year. Usually when I'm evaluating managers, I want to look at a 1, 3, 5, maybe even 10-year horizon. The problem is once you get to a 10-year horizon, the manager might have switched and the fund might not they have to disclose it, but they don't really broadcast it too loudly. So even if the fund has a long track record, then you want to dive in has the manager changed? Because if the manager changes, does the track record even matter? Now every firm is going to tell you, we all follow the same process, but just like any other job, when a new manager comes in, replaces the old one, some things get changed. But on that note, I'll end this chapter and have a great evening.